Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Welcome to Navigating Retirement. I'm your host, Rick Durkee, and we are going to go through a series of podcasts now on a subject that I've spent a lot of time in my career working on, annuities. So we're going to break this down into 5 different podcasts. You'll be able to watch them at your leisure. We hope that you'll enjoy this information and take it and use it in your individual situation. But before we get started today, I'd like to remind you to like, subscribe, and most importantly, share this episode and past episodes of Navigating Retirement. So let's dive in and get started here on annuities. Let's talk about the ins and outs of annuities. Let's talk about how they work in your retirement income plans. Now, first of all, before you make any decision as to any type of financial product and how it integrates into your retirement plans, you should decide first what you want and need your money to do for you. In this 5-part series, we're going to discuss annuities. We're going to discuss why some people think they're good, why some people think they're not so good, the pros and cons, and also we're going to try to understand how annuities could fit into your retirement plan. Now, a lot of folks out there might say, I hate annuities and so should you. Perhaps they had a bad experience. Perhaps they were sold the product, the annuity product. It wasn't dovetailed into their retirement income plan, and they hadn't determined what they wanted or needed their money to do. Annuities have been around for quite some time. They've been a source for debate as to whether or not they are good products to use in retirement income planning, but not always favorably. And so there have been some that have gone on to say that they actually hate these products called annuities. Now, I'm going to back up just a minute, and I want to share a little bit of information with you. For those of you that are perhaps 62 or above and at Social Security decision-making time, you made a decision as to whether or not you wanted to take an annuity called your Social Security payments. And many of you also, actually not as many as it used to be, but some of you that have defined benefit plans, which are also annuity plans or pension plans, had to make a decision as to how you wanted to take that pension payment or annuity payment, and then if you wanted survivor benefits on it. So we've all had some experience with annuities actually already, and many people have categorically dismissed the use of an annuity for maybe some private annuity planning. And today what we want to go into, what the benefits and perhaps the negative sides of annuities could be in your retirement income plan. So we're going to get into a little breakdown of annuities here. And we want to make sure that we're just taking this as base knowledge, because we are going to go into detail in a future episode on the different types of annuities. And so what we're going to do is do a quick breakdown of the different types of annuities right now and what I call an Annuity 101 class. We are going to have a future episode on our series, our podcast series here on annuities, where we'll break it down into a little bit more detail, but let's go over them really quickly. First of all, you have a SPIA, a single premium immediate annuity. It's the type of annuity where you give an insurance company a lump sum of money, and then they give you a guaranteed payment for a lifetime period. There's a lot of different options as far as how you want that money guaranteed as far as income goes. We'll save that for the next episode, though, on our podcast series on annuities. The next type of annuity is a fixed annuity. A fixed annuity works similar to, but does not offer FDIC insurance like a bank CD does, but it works similar to a CD at the bank. The insurance company declares a period of time that interest is fixed for. You defer that annuity for some period of time. Typically in this fixed annuity, you're just going to put it in there. You're not going to use it for income. You're going to defer it. and let it grow inside of that annuity tax deferred. And if you're using it for an IRA, you're going to also be letting that money grow on a safe, guaranteed basis. Now, I've used this word guaranteed a few times. It's very important that you understand this. Guaranteed means guaranteed by the strength and stability of the issuing insurance company. You should always research the insurance companies that you're putting money into. Make sure that they're strong and stable. They're all rated by outside rating agencies. You definitely want to work with companies that are A-rated or better if you want to make a stronger case for those guarantees in those annuities. So we talked about a fixed annuity. It works just like a CD at the bank, but it doesn't offer that FDIC insurance. It will give you an interest rate that's guaranteed for a period of time. They're called MYGAs, multi-year guaranteed annuities. They will pay interest guaranteed for a year, 2 year, 3 year, 4 year, 5 year. Typically about 5 years is the length of time we see them last. And those interest rates will pay typically about 1% higher than what the bank's paying in CDs, depending on the term. Fixed index annuities now, fixed index annuities are the next type of deferred annuity. You can start income on them at a future point if you'd like. Fixed indexed annuities give you an opportunity to participate in gains as market indexes go up. However, on the other hand, if market indexes go down, your principal is protected and your income is protected also if you started income on a fixed indexed annuity. So that if markets go down, your indexes go negative, you get a big fat zero. You don't lose a thing, but you certainly don't participate in all those gains if we were comparing this to perhaps a variable annuity, which a variable annuity will work just like the fixed index annuity, except for you will have exposure to markets and market indexes and market type mutual fund type investments inside of that variable annuity. As the market goes down, your accumulation value will also go down in a variable annuity. Now, don't have a lot of time to go into these today. We are going to go into them more in the future. But all annuities can offer riders. They can be built into them, into the products. They can be side riders that you pay fees for. There's different fees on different products. Let me just say this as a blanket statement. All investment companies, they make money, right? All banks make money. All insurance companies, just lay it on the table, make money too. So you need to evaluate in each type of financial product what type of fees you're paying for those products. And if you're willing to go through a process to evaluate those fees, you'll find that they are actually all made available to you to understand how much those financial institutions are making on all those products. So I'm not going to get into details of fees and things like that, but typically in annuities, you have fees once you add a rider to that contract, or you're getting some type of benefit that offers extra protection or extra growth potential, or some other benefit, maybe if you pass it on in a legacy, the death benefit of the contract may be enhanced in some type of contracts. Listen, a lot of information, a lot of details. I want to continue our series. That's all the time we have for today. We'll pick it back up with some more discussion on annuities, on navigating retirement, and we look forward to having you for our next episode on understanding annuities.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.